Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 17th of August. I'm Daniel Lam, your host for the podcast. On Monday, I started another 6-game training match in preparation for the Asian Games, this time against a Russian opponent who was working in Hong Kong. I played very well throughout the entire game and had every reason to expect a victory. Unfortunately, I made an error in the endgame and I lost. Now, of course, it was difficult to accept this, but life is full of unexpected turns. And let's not forget that I started off in the worst possible way in my previous match, and I eventually won 4-2. So let's hope for a repeat in Game 2 and also in the future. Now, there was every reason to expect a rally in the Hang Seng Index a couple of weeks ago, with the Politburo pledging support to the economy, combined with the beginning of some shaky data in the US, which may lead to rotation back into Hong Kong China equities. But unfortunately, things have taken a U-turn since then. We had further weakness in the Chinese economic data, such as inflation, trade data, and slowing credit growth. There were issues with the property sector out there, and there were news about pressure on the local trust, and the US economic data continues to stay strong. So this led to the Hang Seng Index breaking below the key support at 18,562. And that destroyed the upward wave that the index chart had been indicating technically since 6 weeks ago. The next two key levels to watch for the Hang Seng Index are 18,279 and 18,045. Now, if these levels were to break, then there would be more downward pressure on the index. But if the index holds above these levels, then it is likely to enter a period of range-bounding moves. And in order to resume the upward movement, the Hang Seng Index needs to break above 19,346. Now, enough of the technicals. What are the macro drivers to watch out for here? Obviously, in order for investors to regain confidence in Chinese assets, or at the very least, short cover, there would need to be some meaningful stimulus in order to backstop the issues surrounding Chinese assets. Secondly, the external environment needs to be calm. One needs to watch out for potential inflationary pressure. That would be one of the key risks out there. And why is that? Well, it's because oil prices have been firm, which had led to rising bond yields, and in turn, tighter US dollar liquidity conditions. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.